All right, absorption stage.
Okay.
You will see minor supply in the marketplace.
Demand begins to decline.
Why? Because people are starting to take over the inventory. The demand is beginning to increase. Typically, that demand growth is coming from, again, real investors. The vacancy decreases to a balanced rate because, by the way, there will always be some vacancy. No matter what you do. But when you're starting to see it stabilize, then you know that you're within the absorption stage. And ultimately, your rent rates now see some growth. Doesn't necessarily mean that it'll go back to $30 a square foot. You might slightly see the growth patterns of the rental rates per square foot, the rent cost per door. I mean, there's all kinds of things you'll look at, but you'll see that. During the growth stage, it's pretty self-explanatory. Supply begins to increase, but the demand now is greater than the new supply. So now there's more buyers in the marketplace. So builders are coming in. That's typically when you start seeing the new building cycle take into effect. And people start building more because there's a higher demand for the very inventory that's left. You have the vacancy is declining to lows. So if your average vacancy over the last 10 years is 10% and you're at 6, you know you're growing because that's not normal. Right? And your rent rates see positive growth. This is when you begin to see the retail cost of doing business. Okay? Saturation stage. The supply is increasing greater than the demand. People don't know it yet, though. Then, of course, the demand is positive but begins to slow down. And that's typically when you'll start hearing the news and the media talking about things. Right? The vacancy increases to a balanced rate. So all of a sudden, you had a vacancy factor minute. Now it goes back to stabilized. When you start seeing when you are at 5% and now you're starting to see it go to 8%, you know that you're in the saturation stage and you need to be very careful. This is one of the most dangerous parts of the real estate cycle. So you need to be real cautious about how you do business. Vacancy increases to balanced rate. Then the rent rates are positive but are slowing down. And the way you see that typically is the days on the market. So you can start finding where typically where it was taking 90 days to do a deal, all of a sudden it's 120. And things are cooling. In the real estate residential market, you had 30 days on the market. And all of a sudden, 60, 90, 120, boom, boom. Some people are sitting on there for years now. Because, first of all, the price points, the market was hit differently. But again, these are patterns that you need to look at. And at a glance, when you're going into the real estate market that you're focused on, you can use these indicators to identify where you are. Now, all these other elements that we talked about here are going to be important too. But you want to be able to, like the rule of thumb I talked about. All right, this is about what's going on right now. Let me dig in. Let me find out more. You'll find out working with experts and using other resources that I'll share with you in just a moment. Another thing you'll need to look at is employment, which you had right on the money. Watch the employment numbers so that you can get a pulse on the local growth. When the unemployment rates are extremely high, you can see that the market is coming back up just by seeing the basics of that number drop. But be cautious because the government right now is creating fake jobs. So that's another thing you have to be careful with. That's one of my bigger concerns.